Out of President Trump promising to double tariffs on foreign steel and announcing a major deal with Japan as Elon Musk officially leaves his role at the White House. ABC's
Canada won't bow down to a bully. And we won't stand by as tariffs hurt our workers and their families. Trump wants us to lose our cool and to cave in.
Donald Trump's recent and highly impactful announcement of a sweeping 50% tariff on copper imports has been met with a remarkably calm, confident, and meticulously calculated response from Canadian mining companies. Welcome viewers to my channel. If you're new here, please subscribe, like my video, and turn on notifications so you don't miss our next update.
America is not Canada. And Canada never, ever will be part of America in any way, shape, or form.
Yeah, President Trump is once again vowing new tariffs, this time saying he'll double tariffs on imported steel from 25 to 50%. The president says they'll kick in.
This reaction stands in stark contrast to the significant and widespread skepticism expressed by a broad range of financial analysts, economic observers, and commodity strategists. The proposed tariffs, which were declared with limited and somewhat vague details on Trump's Personal Truth social platform, are officially scheduled to take effect on a firm date of August 1st. However, despite the sharp and often aggressive political rhetoric and the sheer magnitude of the proposed tax increase, experts and industry insiders alike believe the immediate economic fallout for Canada will be minimal and largely contained. This conclusion is based on the fundamental nature of the intricate global copper supply chain and, more specifically, the particular types of copper products that Canada predominantly exports to the United States and other international markets. The unique structure of the industry serves as a crucial buffer, mitigating what would otherwise be a devastating and catastrophic blow to the Canadian economy and its vital mining sector. This measured and deliberate response from the Canadian side indicates a deep and sophisticated understanding of the underlying economic realities that extend far beyond simple political pronouncements. The nuances of the copper trade and the U.S. industrial gap factory. A primary and crucial reason for this remarkably muted and pragmatic reaction is that Canadian mining companies, by and large, primarily export copper concentrates. These concentrates are a raw, unrefined, and unprocessed form of the metal. They are the initial product of the extensive processing of copper ore, where the copper content is carefully increased to a more manageable and concentrated level of approximately 25 to 30% before being sent for the next stage of refinement. This product is almost exclusively shipped overseas, with the vast majority heading directly to China. This trade pattern is not a matter of a conscious business choice, but is an economic necessity dictated by global industrial dynamics, as China has strategically and purposefully positioned itself as the undisputed global leader in the copper processing and smelting sector. According to highly credible data from Wood Mackenzie, a leading natural resources consultancy, China has been responsible for a staggering 75% of all new global copper smelting capacity added since the year 2000 and has accounted for virtually all new additions in the last 5 years alone. On the fabrication side of the business, where the refined metal is meticulously turned into useful and final products like electrical wires and plumbing pipes, China has added an astonishing 80% of all new capacity since 2019. The United States, in stark contrast, simply and fundamentally lacks the massive, modern, and high-tech infrastructure required to process these raw concentrates on a similar or even remotely comparable scale. This significant and critical industrial gap is a foundational factor in understanding precisely why the proposed tariffs are highly unlikely to disrupt the Canadian copper industry's core and highly profitable business model. The U.S. domestic copper industry has been in a steady decline for several decades, with its smelting and refining capacities a mere shadow of what they once were, a reality that cannot be altered by a sudden and dramatic tariff. This long-term industrial deficiency creates a natural shield for Canada's specific export niche. Because the U.S. processing capacity is so profoundly limited and insufficient, the tariffs will not be able to significantly or fundamentally alter the established flow of Canadian copper. Michael Dobner, an economics and policy expert at the renowned consultancy PwC Canada, explains in meticulous detail that the majority of the tariff's financial burden will fall squarely and directly on U.S. companies and, ultimately, on American consumers who will be forced to pay higher prices. Copper is an absolutely critical and indispensable component in countless modern and technologically advanced products, ranging from electric vehicles and renewable energy systems to consumer electronics and essential construction materials. U.S. businesses and manufacturers cannot simply cease importing it without facing major disruptions to their production lines and a subsequent loss of competitiveness. Consequently, they will be forced to continue purchasing it from established and reliable suppliers, including those in Canada, and will be compelled to absorb the higher prices resulting directly from the tariffs. Dobner anticipates that most of that tariff will be paid by U.S. companies who are buying that copper, concluding with certainty that the impact on Canada in the short term will not be significant. The U.S. is highly dependent on copper imports, relying on them for roughly half of its total annual consumption, and it would realistically take at least a decade or more to develop the domestic infrastructure needed to even begin to approach self-sufficiency. This reality makes the tariffs' stated goal of boosting domestic production a long-term, highly speculative, and financially burdensome endeavor. The immediate effect will be higher costs for American industries, not a sudden surge in domestic output. Drawing parallels with other industries and assessing broader risk bar chart, this specific and unique situation is not without a historical precedent, providing a crucial framework for analysis. It closely mirrors the challenges that were faced by Canadian aluminum producers, who have largely managed to maintain their sales to the U.S. market despite the imposition of high tariffs, because the U.S. aluminum industry also had insufficient domestic production capacity to meet its own internal demand. In stark contrast, Canadian steel producers were hit much harder by previous tariffs because the U.S. had significant excess capacity, making it considerably easier for American companies to substitute domestic steel for imported Canadian steel. The current copper situation, therefore, more closely resembles the aluminum case, providing a strong and reassuring basis for the current state of calm among both Canadian producers and market analysts. The cool-headed reaction from financial markets is also highly revealing. It suggests a patient wait-and-see attitude, with some analysts believing it indicates a fundamental and deep-seated distrust of the policies themselves. Derek Holt, head of capital markets economics at Scotiabank, suggests that markets are deeply skeptical of the longevity and overall credibility of Trump's moves, given his well-documented erratic ways. Holt forcefully and directly argues that there is no sensible rationale for these measures that American consumers and businesses will pay for. The immediate and substantial cost to the U.S. economy, combined with the profound lack of domestic processing capacity, makes the policy's long-term viability and effectiveness highly questionable and subject to doubt. The tariffs are a blunt instrument that fails to address the core problem of a lack of processing infrastructure and instead punishes U.S. manufacturers. While the direct and immediate impact on Canada may be largely contained, there are broader, more nuanced, and long-term risks that must be considered. The mere threat of imposing tariffs on copper, a foundational and essential metal for the entire modern economy, has already driven up prices within the U.S. According to BMO senior economist Robert Kavcich, while the approximately $9.3 billion in annual copper exports to the U.S., based on comprehensive 2023 data, is far less in raw value than the over $34 billion in steel and aluminum exports, the broader implications are still significant and worrisome. Quebec, which is home to Canada's only copper smelter, will be the most directly and acutely affected province. However, the larger and more pervasive concern is the negative impact on overall business confidence, which is a fragile and essential component of economic stability. Kavcich notes that even if a copper tariff is relatively contained, it would be another shot that impacts business confidence more broadly, potentially discouraging crucial investment and leading to a climate of widespread uncertainty. Michael Dobner of PwC Canada echoes this serious concern, warning that higher copper prices could drive the U.S. to a less vibrant economy, pushing its economic growth even lower. Ultimately, these tariffs are seen not as a strategic and clever economic lever, but as a potential